Have you ever wondered how the stock market works? It's an intriguing world filled with a fascinating blend of strategy, analysis, and a pinch of good fortune. So what exactly is it? Simply put, the stock market is a marketplace. But instead of buying and selling goods, you're trading company shares. Picture it as a grand bazaar where investors, big and small, come together to trade their pieces of the corporate world. These investors could be anyone from individuals like you and me to large institutions such as pension funds. The companies whose shares are being traded are what we call public companies. These are firms that have decided to sell a part of their ownership to the public. Why do they do this? Well, it's a way for them to raise capital. The stock market is an essential cog in the wheel of our economy, facilitating the exchange of capital and investment. So, at its most basic, the stock market is simply a place where buyers meet sellers to trade shares. Now, you might be wondering, what exactly is a stock? Well, in the simplest of terms, a stock represents a share in the ownership of a company. When you buy a stock, you're essentially purchasing a small piece of that company. You become a shareholder, which means you now own a fraction of that company's assets and earnings. Now you might ask, why would a company sell its stocks? Companies issue stocks to raise funds. They use these funds for various purposes like expanding their business, paying off debt, or launching new products. In return, they offer a share of their profits to their stockholders. Owning stock in a company comes with certain rights. One of these is the right to vote on company matters. The more shares you own, the stronger your voting power. Another right is the potential to receive dividends. Dividends are a portion of the company's earnings distributed to shareholders. Not all companies offer dividends, but those that do can provide a steady stream of income. But remember, owning stocks isn't just about the potential benefits, it also comes with risks. The value of a stock is tied to the company's performance. If the company does well, the value of your stock may increase. But if the company struggles, the value of your stock may decrease. And in the worst-case scenario, if the company goes bankrupt, you could lose your entire investment. But don't let this scare you off. The stock market has proven to be a powerful wealth-building tool over the long run. While there are risks, there are also strategies to manage them. And we'll get to those in the upcoming scenes. In essence, when you buy a stock, you're buying a tiny slice of a company, warts and all. But you're also buying into the potential for growth and the chance to share in a company's success. And that, in a nutshell, is what owning stocks is all about. Stocks are bought and sold on venues known as stock exchanges. Picture Wall Street's bustling scenes or the ringing of the opening bell at the New York Stock Exchange. These images are synonymous with the world of finance and stocks. But what role do these stock exchanges play? Primarily, stock exchanges serve as marketplaces. Think of them like a grand bazaar where buyers and sellers from all corners of the globe come together. However, instead of haggling over the price of spices or textiles, they negotiate on the price of stocks, bonds, and other securities. But that's not all. Stock exchanges also play a crucial role in maintaining a fair and transparent trading environment. They do this by enforcing strict rules and regulations to protect investors and maintain the integrity of the market. For instance, companies listed on these exchanges are required to disclose certain financial information, which ensures transparency and helps investors make informed decisions. Moreover, stock exchanges add a layer of liquidity to the market. They enable the easy buying and selling of securities, which is essential for both companies looking to raise capital and investors seeking to diversify their portfolios. Now, you might be wondering, why are there so many different stock exchanges? Well, each exchange has its own unique set of listing requirements, trading systems, and market participants. Some, like the New York Stock Exchange, are known for listing large, established corporations, while others, like Nasdaq, are popular among tech-oriented companies. In essence, stock exchanges are the beating heart of the global financial system. They facilitate the flow of capital, promote economic growth, and provide a platform for investors to participate in the financial success of businesses. So next time you picture the bustling scenes of Wall Street or hear the ringing of the opening bell, remember the vital role these exchanges play. They're not just venues for trading stocks. They're the gears that keep the world of finance turning, the stage upon which the global economy performs its daily dance. Without stock exchanges, the stock market as we know it simply wouldn't exist. You've probably heard the phrase, "the market sets the price." But what does that really mean? Let's dive into the mechanics of it. At the heart of every stock price is the simple law of supply and demand. If more people want to buy a stock demand than want to sell it supply, then the price moves up. Conversely, if more people want to sell a stock than buy it, the price falls. This is the basic principle that drives stock prices. But what influences this supply and demand? Well, a variety of factors. Firstly, company news plays a significant role. If a company announces better than expected earnings, launches a new product, or makes a promising acquisition, it can create a surge in demand as investors anticipate future growth. On the flip side, negative news like lawsuits or poor earnings reports can lead to an increase in supply, as investors may decide to sell their shares. Next, we have economic indicators. These are key statistics about the economy that can sway investor sentiment, like inflation rates, unemployment numbers, or changes in gross domestic product. For example, if the economy is doing well, investors may feel more confident about the future and be more willing to buy stocks, hence driving prices up. Investor sentiment, or the overall mood of investors, also plays a crucial role. If investors are optimistic, they're more likely to buy stocks, pushing prices higher. If they're pessimistic, they're more likely to sell, which can cause prices to drop. Lastly, remember that the stock market is global, and events around the world can impact stock prices. Political instability, changes in foreign policy, or even natural disasters can influence investor sentiment and thus stock prices. All these factors constantly interact, creating a dynamic and ever-changing marketplace where stock prices are determined by the minute. So in the end, a stock's price is nothing more than what someone is willing to pay for it. Like any market, it's the interplay of supply and demand, influenced by a myriad of factors, that ultimately sets the price. The stock market might seem like a complex beast, but it plays a crucial role in our economy. Imagine being in a bustling city where every building represents a company. Now, these buildings need resources to function and grow. That's where the stock market comes in. It's like a vast reservoir of capital, where companies can dip in to gather the funds they need to expand, innovate, and thrive. By selling shares of their business, companies can raise substantial amounts of money without taking on debt. This is how the stock market fuels economic growth and development. But what's in it for you, the individual? Well, the stock market offers a platform for you to invest your money. By purchasing shares, you're essentially buying a piece of a company. If the company does well, your investment grows. If not, it shrinks. It's like planting a seed and watching it grow into a tree. It's not always smooth sailing, but over time, historically, the market has tended to grow. This growth provides you with a way to build wealth, save for retirement, or fund your child's education. Beyond the individual and the corporation, the stock market also plays a vital role on a macroeconomic level. It acts as a barometer for the economy, reflecting its health and direction. Rising stock prices indicate optimism and growth, while falling prices can signal trouble ahead. Policymakers, economists, and investors alike use these signals to make critical decisions that affect us all. In sum, the stock market is more than just numbers and charts. It's a dynamic ecosystem that nurtures companies, provides opportunities for individuals, and serves as a vital economic indicator. It's a place where dreams are funded, wealth is created, and economies are shaped. Without the stock market, our economy and our world would look very different. We've covered a lot of ground today, so let's quickly recap. We started with a simple definition of the stock market, a marketplace for buying and selling shares of publicly held companies. We then delved into understanding stocks, which are essentially small pieces of ownership in a corporation. From there, we moved on to the role of stock exchanges, places where these stocks are traded and how they provide a regulated and organized environment for transactions. Keeping the momentum, we explored how stock prices are determined, a complex interplay of supply, demand, and company performance. Finally, we address the importance of the stock market. It's not just a playground for investors, it's a critical component of our economy, enabling companies to raise capital for growth and innovation. So, the next time you hear about the stock market, you'll know exactly what's going on. It's not so mysterious after all, is it?